All right, good morning, everyone. Thank you for joining us this morning and welcome to the maiden edition of Agusto & Co.'s Market Development Series. The theme for this quarter will be understanding ratings. And the objective really is to provide the market in general with often elusive but very pertinent information about how ratings are conducted. So I hope that you find it useful. But before we proceed into today's agenda, just a few housekeeping rules. We'll be taking questions at the end of the presentations so that we're better able to manage our time. But if there are comments or questions that are burning as the conversation is going on, please feel free to use the chat box. We'll be responding to those comments and taking those questions as well. So without further ado and not wasting much of your time, I would invite the Managing Director of Agusto & Co. Limited, Mrs. Yinka Adelekun, to give us her opening remarks and set the tone for the rest of today.
Okay, thank you very much, Wanu. And good morning, ladies and gentlemen. It's with immense pleasure that I welcome you to our webinar, which is aimed at market development. Agusto & Co., as you all know, and many of you are aware of, has been in existence for 31 years. And we introduced the concept of credit ratings into the Nigerian market. We have since diversified into other countries, including Kenya and Rwanda. As a credit rating agency, really, our primary role is to assess the creditworthiness of issuers, such as corporates and sovereigns. This has led to the development of the debt market, as various issuers have raised debt on the back of their financial standing, showcased by a credit rating. And this has fostered market liquidity and helped investors make informed decisions on their investments. Our ratings are an independent view on the ability of an issuer to meet his obligations, and the rating process internally is upheld by independent functions. As the market continues to evolve, we realize that beyond credit ratings, there's a need for other types of ratings. For instance, an investment manager rating. This is a rating or independent assessment looking at the investment management capabilities of an asset manager and its ability to fulfill its fiduciary role. In addition, we provide ratings to securitized transactions, such as asset-backed securities. Our methodology for the securitized instruments applies to debt instruments issued by special purpose vehicles that are backed by a pool of assets. They can be real assets or they can be financial assets. Today, we will be sharing our methodologies on subnationals, investment managers, and structured instruments. We look forward to having an insightful session with you. We welcome questions, we welcome remarks. And as Wanu has said, we will take the questions and remarks at the end of the presentations. Once again, welcome to our webinar. I know it's a busy Wednesday morning, and we really thank you for taking time to join us on our webinar aimed at the market development. So welcome, and I'll pass it on to Ike, who will take us through the rating of structured finance. Thank you very much. Ike, over to you.
Thank you so much, MD, for that introduction. I'd like to take us through the structured finance rating that we carry out at Agusto & Co. And for that particular purpose, I would want to just start off by introducing what exactly structured finance is all about. So when we speak about structured finance, it's a non-conventional financing tool, different from the traditional corporate instruments that we typically see. So for structured finance, the major focus or the major emphasis for structured finance, it's around securitization of a pool of assets with the means and with the view towards using those assets as security to actually do what? Meet complex needs of companies. So companies have some complex financial requirements, but the challenge becomes how do they access financing that is not typical and is not ordinary. So the structured finance becomes that particular model in which you're able to access financing using a pool of your assets that have been leveraged for that particular purpose. And at the heart of structured finance is what we call securitization. Yes, it's a very big word we use in structured finance balance, but what exactly does securitization mean? In essence, securitization is just a process through which financial instruments are combined, and those financial instruments could be asset-backed securities, credit-linked notes, financial assets that are being combined. And that combination is what helps us to actually do what? Use them as the leverage to raise finance on the back of those assets. And the potential cash flows from assets becomes the driver of repaying those obligations. So that's in a nutshell. It's just trying to explain the structured finance mechanism and how it works. And as we go along, I'll speak about some of the examples of current structured finance deals that are available in the market, and also what we see across other markets. So if you look at the next slide, it focuses on what are the various products that exist from a structured finance perspective in terms of the products. Now we have what we call the asset-backed securities. Now the asset-backed securities, as the name implies, are backed by assets, some form of financial assets. And the assets you could see backing this particular instrument could be what we call auto loans, credit cards, bus tickets, receivables, and alien permit cards. Now, what exactly does an ABS mean in its true sense? The ABS is just specifying that this is a collection of underlying pool of assets that generates income. So therefore, those assets must be income generating assets. They are pulled together and used as the basis to actually raise finance to meet certain needs. And the process of pulling those assets together is what we call securitization. Another variant of structured finance products is what we call the collateralized loan obligations or the collateralized debt obligations. When we specify the collateralized loan obligation, which is called the CLO focuses on a pool of loans. More often than not, these loans are corporate loans that have low credit ratings, and the originator of those loans actually requires financing and therefore pulls those loans together. Those loans are usually homogeneous, and on the back of those homogeneous loans, they're able to raise financing for specific purposes. Then the CDOs, which is the collateralized debt obligations, is now a much more complex structure, still collateralized, but now includes both a pool of loans and other type of assets. So meaning the kind of pool of assets in this bucket are heterogeneous. They have varying characteristics, but the idea is that all of those debt obligations have been put together under one particular umbrella, and on the back of those assets, they're able to raise financing. And on that basis, you can begin to have what we call the tranching methodology, where you're able to now separate those who are the upper end, the senior debt, the junior debt, and also what we call the mezzanine debt. Another type of product, structured finance products would see is what we call the hybrid securities. These are asset-backed securities that are focused on short-term end of the market, like the asset-backed commercial papers, typically notes that are issued for less than 1 year, and they could be backed by real financial assets or even commodities. And we have a case in point in the Nigerian market, which is called the asset-backed commodity papers. Now, these commodity papers are short-term instruments, but backed by commodities that are grown locally in Nigeria. And we've had one issue already on that particular instance. We have FX commodities. They issued 100 billion ABCP note, and the underlying commodities were paddy rice, sorghum, maize, and soya bean. And these were the securities that were securitized in a pool to ensure that funds were raised to meet certain needs of financing requirements. And also the final structured finance products we'll speak around will be the collateralized mortgage obligations. These are quite peculiar around the West, where we have the residential mortgage-backed securities and the commercial mortgage-backed securities, which is the RMBS and the CMBS. For this particular type of credit, what happens is those pool of assets, pool of mortgages are securitized together. And on the back of that, you're able to raise financing. Now, this takes us back to some point in time where we had the subprime crisis. It was on the back of this kind of instruments that the subprime crisis happened in the US. So it's important to understand that all of these are structured finance products, and the list is not limited to this. We have the credit linked notes, the credit default swaps. But I mean, these are the ones that are peculiar and that we see in our everyday practice in the market. So it's important to just give this highlight around those type of securities. And I'd like to speak around the next being, what are those key terms that we use in the structured finance? Just like I explained earlier, it's different from the conventional credit rating, different from the conventional corporate or subnational rating. So there are some key terms that will be important to understand as we go along. We have what we call the over-collateralization. You'd always see this particular concept in structured finance. What exactly does over-collateralization mean? Over-collateralization is just speaking to the fact that the face value of the underlying assets, which is being pledged, is typically larger than the value of the instrument you want to issue, such that you're able to have a buffer in the event there's some shrinkage in the value of the underlying loans. And as a rating agency, we think this is very, very pertinent for issuers to over-collateralize their assets such that when there's diminishing value due to various issues in the market, you're able to still realize the potential value from those assets. And that means by which you make this computation and measurement is what we call over-collateralization. And at Agusto & Co, we always ensure that and enforce the rules that you must be over-collateralized beyond at least 120% of the value of the asset that you're trying to actually raise. Now, another key term that will be important to mention here is what we call credit enhancement. Credit enhancement could come from the form of an internal credit enhancement or an external credit enhancement. When we mean internal credit enhancement, things like over-collateralization could follow. However, you could have what we call a reserve fund, where you've pledged some amount of funds available to serve as a buffer to meet contingencies along the way in case there are challenges with realizing the commodities or disposal of those assets. Then the reserve fund becomes a pool of funds to meet one-time semi-annual payment, which is what we typically at Agusto & Co require as a minimum threshold, that you should have a reserve fund to cover at least one-time semi-annual coupon payment obligation. Then when you look at the external credit enhancement, this is where the guarantees will come into play and your liquidity support facilities. Guarantees are just third-party financing from a stronger credit-worthy entity, and the liquidity facility supports are just a facility support that has been provided as a standby credit to meet obligations if there is a need. Another key term that is important to mention as we go along this particular session is debt tranching. Debt tranching always features in every structured or securitization transaction, and it's just showing the level of debt seniority. Meaning, for a debt instrument, you could have what we call the senior debt and the subordinated or the junior debt. And sometimes you could have the equity holders, ensuring that there is some level of risk and return reciprocate to what level of risk you're willing to take in that particular investment. So debt tranching helps to show the level of seniority in a structured finance instrument. And one other key term I would like to mention again is the special purpose vehicle or special purpose entities. For securitizations, it's always very important that those particular assets, given that you want to finance some special needs, the assets pool is being held in trust by a special purpose entity, meaning you create a vehicle that now warehouses and ring fences that particular assets. And the process of that ring fencing and warehousing is what we call the bankruptcy remoteness test. Why is this important? This is important because it helps ensure that those assets have been put together. In the event there's an insolvency challenge with the parent company, those assets will not be impacted by that insolvency charge or creditors coming after a particular company. So you see that this always features whereby we always have to have what we call our legal opinions to validate that the special purpose vehicles are bankruptcy remote and is important for every securitization transaction. The next key term is true sale. What exactly is true sale? This is just a legal terminology used to explain that the sale of a particular asset into a pool needs to have been done both in intent and in the acts of the law, meaning there must be a valid sale, which ensures that those assets, there will be no recourse on those assets from creditors if there is a need. Then some of the other terminologies, which I think may just be, I'll just speak about them quickly, would be expected credit losses. Because it's a structured deal, we need to understand what amount of losses are we expecting from this transaction. And we look at the losses from the standpoint of today up onto the life of the whole instrument itself, where we typically measure the expected loss from a standpoint of probability of default, the loss given default, and also the exposure at risk at default. Another key metrics or key terminology we consider is what we call the cash flow waterfall. What is the hierarchy in terms of the payments to the final bondholders? And also we look at the expected and final legal maturity. This is one unique feature of structured finance, whereby you could have a shorter expected maturity timeframe vis-a-vis a longer maturity timeframe. And one of the cases in point that is quite peculiar in the market is the securitization of foreign workers permit card called alien cards that was done by SEPAC in 2018. This had a tenure of 7 years final legal maturity, meaning that is the latest date within which this obligation must be paid, but had a 5-year expected tenure, meaning from their computation, from their analysis, they expect to pay back in 5 years. However, if they do not pay back in 5 years, default has not occurred because the final legal maturity period is 7 years. And I can confidently tell you this particular instrument was paid down within 5 years, within the expected time frame, and the legal maturity time frame still existed. But the idea is that structured finance allows you to play around the structure from perspective of the expectation and also the final maturity. I'd want to take you through what a typical securitization structure looks like before I speak about our rating criteria that helps us in arriving at a rating for structured finance products. A typical asset securitization structure starts with an SPV in the middle, which is the security issuer. But on the back of that, you have an originator, the guy who provides the assets. This is the guy who has the assets. It could be a pool of assets. It could be a pool of originators, when we call the multi-issuer or multi-sellers. You have multiple issuers providing the assets. The originators provide the assets. However, you also have the investors who are buying into the ABS, which is the asset-backed securities. Now, that is the first chain and the first layer. On top of that, you have what we call the servicers, where Agusto & Co. will typically conduct what we call a servicer quality rating, not a credit rating, but a servicer quality rating to understand the servicer's competence, capacity, and capabilities in terms of collections from the underlying assets to meet the bond obligations. But that role is not completely handled by the servicer because the trustee ensures that payment obligations, payment milestones are done as at when due to the investors. So you have the trustee coming in that particular loop. Also, as part of the securitization structure, you typically have a guarantor or a credit enhancement to provide some level of support and comfort given the riskiness of the particular transaction. And here you have a guarantor or you have your external credit enhancement support like a liquidity facility support I mentioned earlier. Then for foreign currency transactions where you have counterparties across the globe, you have a hedging counterparty that provides you with a hedge mechanism, either a futures or a forward, just to ensure that you do not lose out at the endpoint from a foreign exchange perspective. Then obviously the rating agency like Agusto & Co. puts together all of this conversation, all of these parties, all of these structures into a model in an attempt to try to do what? Arrive at a potential rating that meets the characteristics of the structure and also the risk element in that particular. And I'll just take you quickly through Agusto & Co.'s credit rating criteria for the structured finance products. From a credit rating criteria perspective, the things we look at are 7 of them, but this list is not endless. First of all, we look at the originator, the guy who's generating the assets, the credit rating and the credit quality of that particular originator. And exactly what we're trying to appraise here is the financial condition, the financial standing. Can this originator continue to actually produce these assets? Can it continue to actually ensure these assets are viable, assets can generate income? And we also look at the linkages between the originator and the asset that has been provided. Does the originator need to continue to provide services to ensure the assets continue to operate? And I'll give you one of the typical examples in the market where we have what we call the Primero securitization. Primero, as we know, is the bus company that handles the mass transit in Lagos. Primero came to the market to raise about 16 billion in 2017 to finance bus purchase, and they pledged the bus ticket receipts as the means of repaying the bond obligations. However, it is pertinent that those buses must be on the road for them to generate bus tickets receivables, and therefore the linkages between the company, the originator, and the assets is so critical in this analysis. For some other type of structured finance transactions, the linkage may be loose, but for this particular instance, the linkages were very, very important, and it primarily had to continue operating for them to generate bus tickets receivables. Another criteria we look at is what we call performance risk. Under performance risk, we're looking at the originator and the servicer linkages from an operational standpoint. We're also looking at the track record of these assets. How have they performed in the past? There's usually what we call a waiting period to test that these assets can live up to the expectations. So those track record is also very important in measuring performance, that we're able to model a cash flow that enables us to make a decision around the riskiness of the potential cash flows coming into the business. Another credit rating criteria we look at is the quality of the obligors, this underlying asset type. What's the credit quality? Do we have any studies on this? Can we forecast potential upsides and downsides to this particular asset type? On the back of that, we're able to now arrive at some conclusion around the volatilities involved and potentially take a haircut. In some instances, we take 10%, 20%, 50% haircut on the underlying asset because of the realizability of that particular asset. So it's very important to note that that also goes into our consideration in trying to arrive at the risk rating for this particular instrument. We also look at the impact of cash flows, future cash flows on this transaction. We model the cash flows for today and into the future over the tenure and understand the appraisals that we need to do to ensure that these cash flows, what supports needs to be in place to validate that these cash flows continue to come in over the life of the asset. And on the back of that, we now measure some debt service coverage ratios to ensure that these cash flows are adequate enough. We also look at the structure and the payment risk. What are those risks involved in payments, which is where the servicer comes to play, the trustees, they all come to play to ensure that the transaction structure is watertight, both from an operational standpoint and also from a legal standpoint, and there's adequate cash flows and adequate buffers, which is where the credit enhancements, all of that comes to play to ensure that there is sufficient cash flows to meet the obligations as a window. And obviously, given the technicalities involved in the structured finance, legal becomes very, very important, where we've mentioned the bankruptcy remoteness and also the true sale. Those we now have our third-party legal, independent legal providers who provide us with a legal opinion on especially the bankruptcy remoteness and also the true sale of those assets. And finally, we look at the credit enhancements, both the internal credit enhancements and the external credit enhancements. At Agusto & Co, these are the 7 key criteria we look at in trying to adjudge what risk profile will be assigned to that particular structured finance instrument. And a final slide I would like to talk us through is just definition. Given that this is a structured finance and it's different from the conventional, we use the suffix FX to distinguish between a structured finance rating and a conventional rating. So we have our ratings from AAA to D, which is the conventional methodology we have. But the distinguishing factor is the FSF, that is a superscript on the alphabet and also the definition. So for a AAA structured finance product, it would mean a structured finance product with the highest quality debt issue, with minimal risk, strongest capacity to pay returns and principal on those debt obligations relative to other issuers in the country. And the same conversation goes down up to D. So similar for all other conventional issuances, the investment grade ratings will be from BBB minus and above to AAA, and anything below BBB minus will be speculative grade investment. So this in a nutshell is how we look at and consider our structured finance ratings at Agusto & Co. And just like we mentioned, we'll be happy to take your questions and feedback at the end of this particular session. Thank you.
Thank you very much for that, IK. I'm sure there'll be tons of questions once we enter the Q&A session. So my name is Wanu Kunle-Bello, and I lead the Fund and Investment Managers Ratings team at Agusto & Co. This morning, for the next 10 to 15 minutes, I'll be talking you through how we rate or assess investment management companies. So how we rate asset managers, really. So this type of rating is called the investment manager rating. And I'll start by telling you what it's not. So the investment manager rating is unique, not necessarily because of its complexity, but in terms of what it measures. So first and foremost, it is not a credit rating. That means it's not measuring the capacity of the obligor to repay. And it is not a financial condition rating, which means we're not looking or we're not assessing the financial strength of an asset management company. It also means that this rating cannot be used to access the debt capital market in terms of raising funding. However, what is an investment manager rating? So what does it do? Why is it useful? So when we look at investment manager ratings, it's a qualitative assessment. And we're looking at the strength of an organization in terms of its investment and risk management capabilities. We're trying to measure how well put together an organization is. It focuses on the capacity of the asset management company. How well is it structured to carry out its fiduciary role? Because it is qualitative, we look at things like people, systems, and processes. This trifecta of factors is then applied to a series of key functions within the asset management company. And then that's how we ultimately determine our rating opinion of the asset management company. These investment manager ratings have become increasingly popular because there's a requirement by the PENCOM, the regulatory authority for the largest holders of wealth in Nigeria, the PFAs, for all potential asset management companies to be rated before funds can be disbursed to such companies, and where investment manager ratings come in. In terms of our rating criteria, we look at three broad areas. We look at governance and structure, we look at investment management, and we look at risk management. In terms of governance and structure, we start with the board. We look at the composition, the expertise in terms of the membership of the board. What previous experience do they have? What other boards have they sat on? We look at their qualifications. We look at the mix in terms of executive membership, non-executive, and whether or not there's an independent member. We look at the stability of the board as well. How long have these members been on the board? Is there a rotation? Is it adhered to? And what is the quorum for decision making? Is it a simple majority? Does one member have more influence than others? Those are things that we assess. We don't restrict our assessments to just the board. We also look at the quality of management in terms of their experience and how well they've been able to implement previous strategies. That will give an indication of our expectation of the success of any strategy implementation that they would embark on. We also look at the organization as a whole and look at things like segregation of duties. We look at adequacy of staff across key functions. We look at reporting lines. How clear are the reporting lines? And segregation of duties also implies that people are unable to initiate and close out a transaction. And that also in itself sort of minimizes operational risk events. Then, of course, we look at succession planning, which you would agree with me has become very critical, particularly in the era of significant migration out of the country. In the past couple of years, we've realized that the asset management industry has been disproportionately more impacted than the wider financial services industry, in that you find entire functions practically vacant because of exits. And so it's been a struggle for the industry. But with succession planning, you know who. So what we really try to measure is how well prepared are you for those exits? What's your potential pool, your universe of potential employees? Then when it comes to investment management, this is the heart of what any asset management company does. And here we look at 4 key areas. We start with research and we look at the quality of research. Of course, here we applied the trifecta factor where we look at the quality of people. So who's leading the research team? Who are the members? How well integrated is this research team with the investment team? Is it the same team? We look at the experience of the people, the experience with the organization itself. And then, of course, we look at the tools that are used, the sources of information, where you rely on third-party research, the quality of the third-party research, how you filter and select third-party research providers. We look at how the asset management company would analyze data or market information that comes into play, and how all of this information will fit into a decision that is made. So with decision making, again, we look at the people, the systems, and the processes. With people, we understand that there might be multi-committees. There'll be different sets of people responsible for decision making. We examine each one to determine competency, expertise, and adequacy. Then, of course, we look at the process. What's your buy-sell discipline? Do you have documented processes on what would trigger a purchase, what would trigger a sale, and how well have you adhered to this? We would also look at things like where it exists. if you've defined perhaps a universe of eligible instruments, what criteria have you used in selecting that universe? We look at your asset allocation strategy. Is it risk-based? Is it developed based on the expectations of the clients? Is it per individual clients, or do you adopt a strategy where you pull the clients into risk areas, risk buckets, and then how you apply that? So we look at what the asset management company does at its heart and how that strategy is implemented, really. Then, of course, we also assess the tools that support the decision-making process. How effective are the tools, and how well they're able to support the company in achieving its objectives. We also look at the reporting and settlement systems. Okay, so who are the brokers that are used? Are they external to the organization? Is the organization part of a group that is able to leverage third-party brokerage services? When it's not, what's the selection criteria for those third-party brokerage firms? How do you determine who it is that you'll be transacting with? Do you have, does the company have options? Is it just the one entity? And what's the quality of that entity? Years of the experience, trading volumes. We also look at the process in itself, where all the third-party linkages come in. So you think about the trustees, the custodians, the settlement process, the length of time it takes to settle transactions. We look at all of those things and see how well it aligns with industry best practices. Then, of course, last but not the least, we look at the investment performance and adherence to strategic objectives. Because ultimately, what is an asset management company set up to do? To invest people's money and to do it well. And to be able to do that, one way that we're able to measure that is to see your investment performance. Because ultimately, if you do your research well, your decision-making process is good, you have good reporting and settlement systems, it should naturally translate to good performance. And when we're looking at investment performance, we're looking at it in that fiscal year, and we're also looking at it over a 3-year period. We're looking at the performance relative to set benchmarks, internal benchmarks determined by the entity itself, and against the inflation rates, just to be able to see if this company is able to return real positive returns. Then, of course, that also merges with a measure of adherence to strategic objectives. How well are you enhancing value within the universe of what you've defined as your core activity? Then with risk management, it's a dual-pronged approach. So we look at investment risk on one hand, and we look at operational risk management on the other. With investment risk management, again, we apply the trifecta of factors. We start with the people. We look at who are the people responsible. Usually it will be a combination of people or teams. We look at the expertise, the competence level, the experience, exposure. We look at how long they've worked, stability within the organization. And then we also look at the systems that have been used. What portfolio management tool do you have? How well integrated with all the other functions is that tool? What can the tool do for you? Is it able to flag off breaches post-trade? Or is it able to have limits already hard-coded into that system in such a way that you cannot enter anything outside of the predefined limits? So that way it prevents breaches pre-trade. Those are things that we examine when we're looking at the strength of systems. Then we also look at the process in itself. So what are those safeguards that you have in place to manage credit, liquidity, interest rates, exchange rate risks? How have you defined what your credit criteria is? And how are you ensuring that you're within the limits that you've set for yourself, for the company has set for itself? Then we look at operational risk management. When we're looking at operational risk management, we're trying to assess the independence of key functions: risk management, internal audit, compliance, control, even information technology, because all of these functions work well together to manage operational risk holistically. So when we look at that, we look at the independence of the functions, we look at the leadership of those functions, we look at the dependence level of those functions on the other functions within that risk bucket, and we form our opinion on the quality of the people. We also look at the tools that are being used to manage operational risk. What sort of tools are being used? How proactive is the organization in receiving feedback? When breaches do occur, which naturally they do occur, what's the escalation process? Who's the first to know? What's the cure period? All these things, are they documented? Look at your standard operating procedure, your manuals, your guidelines. We look at those things and assess how well has this company put these things together, put this information together, because documentation is essential. Practice is often different from what is said. So it's important to see that practice also aligns with the information that has been documented. But of course, we look at the process in itself. So how does the internal audit function work? How does the risk management function work? The level of monitoring, the level of reporting, the escalation, and eventually, altogether, the number of operational risk events that perhaps have occurred or have been prevented from occurring. We measure those things and form an opinion on the quality of risk management. All of our opinions are typically documented in a report. And that report is organized, across 8 different categories. So we start with the corporate profile, we move to business structuring and staffing, we give our opinions on research, decision-making, trade execution, investment risk management, and operational risk management. So ultimately, what we do at Agusto is we assign ratings. Ratings are opinions, and to express our opinions clearly, we adopt the simple alphabet standard. So it runs here from AAA to B. The rating definition and the rating atonement itself is a bit different from the traditional credit ratings. And the idea is, at a glance, an investor, a potential investor, PFA, anyone looking at a report is able to see at a glance that, oh, this is not a credit rating. It's not a measure of financial strength. Rather, this rating is indicative of the structure of the organization, the investment and risk management capabilities of the organization. So in addition to the typical alphabets that you would see with the rating, we have the IM, which is in bracket and attached to the rating. That IM just means investment manager. And it's to signify at a glance so that there's no confusion within the industry. So people at a glance can tell that, okay, this is not a financial strength rating. It is not a financial condition rating. I cannot use this rating to determine the credit capacity of this asset management company. Rather, I can use this rating to determine the strength of this asset management company in investment management and risk management. Right. So the ratings run from AAA to B, with AAA being an investment manager that is considered to have excellent investment and risk management capabilities. And it runs through from excellent to very good, good, adequate, and of course, inadequate to poor. In addition to the conventional alphabets, we also have what we call modifiers. And that's where you find those little pluses or minuses attached to a rating. Those pluses or minuses just help us to reflect the relative position of a company on a rating scale. What do I mean? So let's take, for instance, if an entity that has scored between 60 to 69 is categorized as AA. Surely you'd agree with me that that entity that has scored 61 or 62 is not necessarily of the same quality as that entity that has scored 68 or 69. So it's important to have that differentiating factor. So that entity that has scored 61, 62 would be assigned a AA minus rating, right? While the one with 68, 69 will be a AA plus, for instance. So therefore, any entity that has a plus attached to it is a notch higher than the one without any symbol, and 2 notches higher than the one with the minus. Right? So those modifiers just really show us where this company really is in the rating scale, right? In addition to the ratings, we also have outlooks that we attach because we pride ourselves on our ratings being forward-looking. So while assigning the rating looks at historical numbers, it looks at historical performance, it looks at what has actually happened, we also try to give an indication of our expectations in the short term. So we attach outlooks to ratings. So where you have a positive outlook, what we're trying to insinuate is that there are positive market trends or favorable internal factors that we believe will result in a rating upgrade. So perhaps the company is working towards enhancing its systems, revamping its processes, and we believe that the actualization of those processes or the strategy would result in a positive outcome. So we have a positive outlook. Where it's a stable outlook, it indicates that the entity is experiencing stable market trends, stable internal conditions, and we do not expect that it would result in a rating change. Then we have negative outlook. So naturally, this is where you have negative market trends or adverse internal factors that we believe, if it does crystallize, will result in the rating being downgraded. So, just to explain what those are. So I'll end my presentation here. As I said at the start, we'll be willing to take questions at the end of the three sessions. Thank you very much for listening, and enjoy the rest of the day. Thank you.
Okay. Good morning, everyone. And thanks to Ikechukwu and Wonu for that wonderful presentation. Okay, so I will take us through rating of state government-backed debt instruments. But before we get to our methodology around rating state government-backed instrument, I think it's important for us to perhaps understand some critical issues around state government ratings. Okay, so we'll take us through the structure of state government finances. And we believe it's important to refresh our minds on the structure of state government finances. So when we get to our methodology around rating state government, it won't be, we'll better understand some of the things we're discussing. So for state government, unlike your typical corporate, their revenue structure is quite different. So we've divided revenue for state government into two broad categories. So we have tax and non-tax revenue. Under the tax revenue, we have personal income tax, which is taxes of citizens or residents of the state. And then we have the state's share of centrally collected revenue, which can be in the form of value-added tax or the state's share of statutory allocation. So for value-added tax, which has at the central level has a value-added tax pool where all the consumption tax are warehoused, and then at the end of every month, then shared among the three tiers of government. So for the value-added tax, state government gets a large chunk of 50% of the net amount in the pool. Also, the federation account, which warehouses the country's oil receipts, company income tax, and custom and excise duties. It's also shared among the three tiers of government on a monthly basis, and state government would typically get 26.7% of that share. Under the non-tax, you have things like asset sales, where state government embark in some form of sale of asset, can be in the form of funds or sale of asset generally. Then you have investment income, like your interest earned, fixed interest earned on investment or dividend income that the state may have earned. And then you have the other income in the form of licenses, fees, or fines. Now, the personal income tax and the non-tax income lines make up what we refer to as internally generated revenue. And at Agusto & Co, we consider this the most sustainable revenue for state government. And state governments with higher internally generated revenue are less dependent on the federal government for statutory allocation. So they are less susceptible to changes in the macro environment. So unfortunately, most states in Nigeria tend to have internally generated revenue that are quite low. Just a handful of states in Nigeria have very encouraging IGR. So most states have IGR that averages about less than a third of their total revenue, which means that for them to be able to undertake any form of recurrent or capital expenditure, they have to depend on the central government. And what has happened is then for them to engage in capital expenditure, they then need to rely on external form of borrowings to be able to do that. And there are two typical instruments that state government use to raise long-term funds. So they can issue bonds or they can issue sukuk. Over the years, states have issued these two instruments in their own name. However, we've seen over the last 5 years a steady rise in the adoption of some kind of special purpose vehicle model by most of these states in raising debt instruments, where, because according to Section 223 of the Investment and Securities Act, the debt to revenue of most states in Nigeria has well exceeded the 50% benchmark. So states are now finding some creative way of still accessing funding from the debt capital market without necessarily putting it directly on their own books. So they go through the SPV route, and this SPV can either be incorporated by the state or it can be facilitated. The state can facilitate the incorporation of this SPV through maybe an issuing house or a trustee. In fact, we've seen some SPVs that their objective will be to service a particular region of the country. So we've seen SPVs whose objective is to raise funding to be able to provide additional funding to maybe states within a particular region, say the North Central region or the Northeast region of the country, okay? And because most of these state-backed instruments are used for infrastructure that are not revenue generating per se, what we've seen is a situation whereby the repayment structure is not just tied to the project itself. So to provide some comfort to investors, the state tend to tie the repayment structure around its earnings, the state earnings per se. So it's either the state issue some kind of ISPO, irrevocable standing payment order on their internally generated revenue, or they issue an ISPO on their statutory allocation, meaning that for the local ISPO or domestic ISPO, if you like, which is on the IGR of the state, an ISPO is issued on the state's bank account, and on a monthly basis, a specified sum is then moved from the state's account to a designated sinking fund account for the purpose of meeting the bond obligation. The same thing applies for the federal government, where before remittances are made to the state account, at source, that amount is deducted and then remitted into the sinking fund for the purpose of meeting the bond obligation. So what we've seen is a situation whereby because of the political risk associated with state government and the possibility of a state government revoking a state ISPO or ISPO on its IGR, the market is more comfortable with a federal ISPO. So we've seen a lot of issuances by either backed by a state government or issued in the name of the state government with a federal ISPO backing it. Okay. So even with the ISPO backing it, there has been discussions around also freeing up states to be able to raise additional funding for infrastructural projects. And because these projects have direct impact on the living standard of the citizens, recently there has been an exemption order. The Federal Ministry of Finance, led by the Honorable Minister of Finance, recently extended the exemption order that allows states to be exempted from the operations of Section 223 of the Investment and Securities Act, okay, where states can then go ahead, even if they are in breach of the 50% borrowing limit to their revenue, they can still go ahead and borrow in their name. However, there are conditions attached to very stringent conditions attached to this exemption. So for states to qualify for this exemption, they need to meet certain conditions. One of them is that the IGR of the state must not be less than 60% of its consolidated revenue over a 3-year period. Another is that the debt service arising from the proposed debt instrument must not be more than 40% of the revenue of the state that has accrued over the last 12 months. And for states or the federal capital territory that wants to issue a debt instrument without an ISPO backing it, they then need to provide some kind of third-party guarantee. And the exemption order also stipulates that that third-party guarantor must have nothing less than an investment grade rating. So with these very stringent conditionalities, you agree with me that there are a handful of states in Nigeria that can meet these conditions. Therefore, we're likely to see states continue to adopt the SPV model in their future issuances. So we're not likely to see states issue debt instruments in their own name. We're likely to see them continue to utilize the SPV model. So with this background on the finances of state governments and how the Investment and Securities Act regulate debt borrowings by the state government, we then want to look at Agusto and Co.'s rating criteria for assessing state-backed debt instruments. And because this is quite distinct from our conventional rating, it still follows our typical methodology for rating. At Agusto and Co., our methodology for a conventional rating is we do a macro to micro, and we adopt that same methodology for rating a state government. The only thing is, because the issuer of the instrument is an SPV, and there is no, SPVs are typically non-operational in nature. So we need to look at the state as the primary obligor. And in assessing the state as a standalone entity, as a primary obligor in this regard, we then need to look at certain criteria, which we've called factors. And we'll first look at events happening at the sovereign level, because we believe that events happening at the sovereign level can positively or negatively impact the ability of any state to meet obligation. More so the fact that most states in Nigeria rely on the federal for their monthly allocation. So anything happening at the federal level will have positive or negative impact on their overall ability. So at the sovereign level, we'll look at the political and economic environment, where we're looking at extent of separation of powers, has there been peaceful changes in leadership? And quite frankly, we've had peaceful changes in leadership in Nigeria. We'll look at things like extent of independence of key institutions like the judiciary in Nigeria that will guarantee the protection of rights to property and investment. In looking at the economic environment at the sovereign level, we'll look at critical indicators like our debt to GDP ratio, our deficit to GDP ratio, and other issues around the quality of infrastructure in the country. So with that, we then, once we've looked at the sovereign, we then look at the state as a standalone entity now. And of course, the political and economic environment will equally apply to the state. So for the state, we also assess if there are sufficient separation of powers between the executive, the legislature, and the judiciary at state level. We also assess the extent of independence and the operation of the court in the state, different judicial establishments in the state and how efficient they are. And we also want to measure the sensitivity of the revenue of the state to maybe say crude oil prices, because we believe that if the earnings of a state is highly sensitive to changes in crude oil prices, then the state ability to meet obligation can be impaired by external event happening in the country. And a point in hand will be what happened during the pandemic, where there was a sharp slump in crude oil prices. And we saw crude oil prices trading at unusual low levels, and how that impacted the country's crude receipts and overall FAC allocation at the end of the day. Okay, so having looked at that, also some of the things we look at is the state GDP vis-a-vis the country's GDP, and that will help us measure the strategic importance of the state to the country as a whole. Then the second factor we look out for is the financial condition of the state. And in looking at the financial condition of the state, we look at the revenue of the state. We want to measure the IGR of the state as a percentage of their revenue to know the proportion of that sustainable source of earnings that is available to the state to meet its obligation. We also want to look at the total revenue of the state vis-a-vis its GDP, and that gives us an impression of the revenue potentials that the state have. And then on leverage, we'll look at critical issues around how adequate the revenue of the state is in meeting interest obligation and also meeting debt repayment. Okay, and of course, we'll look at debt to GDP of the state as well under leverage. In spending, we want to look at the overall payroll spend of a state vis-a-vis its revenue. So the higher this payroll spend, the more the state is likely to be constrained in terms of capital expenditure. So if you're spending more on payroll and other overheads, you're likely to have minimal resources available for capital projects, and that will require more borrowings or additional borrowings. We also measure the financial flexibility of a state. For state governments, there are 3 payment lines that we consider non-discretionary. So whether they make enough revenue or not, they are expected to meet those 3 payments. And those are interest payments, statutory transfers, and payroll to salaries to workers. So these are considered non-discretionary. And once we back this out from their revenue, we get what we call discretionary cash flow. And we want to be sure that your discretionary cash flow is at a level that is also sufficient to meet certain repayment obligation, because it puts pressure on a state's financial flexibility if that portion of discretionary cash flow is quite low. And lastly, the third factor we look out for is the quality of economic program and managers. And for state government, most of the state government in Nigeria tend to have economic programs on how the state intends to meet how the government intends to achieve the promises it made to the citizenry during campaigns. And we want to measure those programs to be sure that they are achievable, and that gives us an indication of the quality of projects and quality of infrastructure that the state are likely to have going forward. And also we want to look at stability in the state, the political stability. Has there been turmoil? Has there been squabbles between the tiers of government within the states? And we look at the quality of reporting, okay? First, we look at timeliness, and also we look at quality. And for quality, we're assessing if the state has fully migrated to IPSAS reporting as a way of reporting. And all these factors have weights attached to them. And at the end of the day, the total score will give us the credit profile of the state. But remember that the state is only acting here as a guarantor to the state-backed instrument. So we also need to ascertain the rating of the bond here. So the rating of the bond will be a notching of the rating of the state. And there are different things we also look out for when we want to notch the rating of the state. And things are around quality of enhancement, credit enhancement. So is the debt instrument backed by a local ISPO, or is it backed by a federal ISPO? Of course, if it's backed by a local ISPO, the weight won't be as much as when it's backed by a federal ISPO. And we've seen instances where we have a combination of both. So a certain percentage of the obligation is backed by a state ISPO, and a certain percentage is backed by a federal ISPO. We also look at the repayment method. Okay, is the instrument an amortizing instrument or a bullet? Is the repayment structure a bullet repayment structure or an amortizing structure? Because we believe with a bullet structure, it's riskier. And for an amortizing structure, it lowers the risk because a portion of the principal is repaid on a month-on-month basis, or depending on the payment structure, maybe semi-annual or annual basis, depending on the repayment structure. And then we also look at the sinking fund adequacy, where we're measuring the total amount that is warehoused in the sinking fund and how adequate that amount is in meeting the debt obligation. And when we have a sinking fund coverage of up to 1 time, we say it's satisfactory. Okay. And other factors we also look out for, things like we look at the track record of the trustees handling the transaction. Okay, what's their experience level, what's their expertise? Those are the other factors we look out for. And with this notching criteria, a state can actually get up to 5 notches in arriving at the bond rating. So if a state has a rating of, for instance, say BBB, with this notching criteria, and they've met 100% all the notching criteria, their rating for a state-backed instrument can be as high as AA-. However, depending on the extent of the parameters that has been met, we then prorate the notches. So it could be 2 notches, it could be 3 notches, depending on the parameter that has been met. So just to also take us through our rating definition for state-backed instrument. And like our typical rating definitions, it starts with a AAA to D. The AAA being the highest quality debt issue with minimal credit risk, strongest capacity to pay returns and principal on local currency debt in a timely manner. And it trickles down to D. And like Wonu explained when she was making her presentation, the rating category modifier also applies to the rating of state-backed debt instruments. So from the AA to C, we can apply modifiers where we want to show if it's where we want to use the plus or minus sign to show the comparative position of that debt instrument within a particular rating category. So example would be a debt instrument after the notching that would typically, if a debt instrument scores between 70 and 79, typically after the notching, that will give us an A rating. But you agree with me that a state-backed debt instrument that scored 71, for instance, and another that scored 79 shouldn't be on the same pedestal. There should be a way we distinguish these 2 debt instruments. And we use that rating category modifier to show their comparative position within that rating category. So if a debt instrument scored between 70 to 73, that debt instrument will be rated A with a minus sign. Scored between 74 to 76 will be rated A without any modifier. And from 77, for instance, to 79, we'll have A with a plus sign, just showing their comparative position. So thank you very much. I think I would hand over now to the team in charge of the Q&A session. Thank you for your time.
Thank you very much, Christian, IK. So we're heading now into the Q&A. Please note that you can use the Q&A chat box, or you can use the traditional chat box. You can actually also, just send an email to the marketing team, like some attendees have done. So please, we're here to answer any questions that you might have, respond to any comments that you might have on the presentations. I think we have some questions that Ayokunle Olubumi will be taking, and where there are more, we'll be taking those as well. Ayokunle.
Thank you very much, Wonu. And thank you, everybody. Like Wonu said, please feel free to ask your questions so that we can take them all. I think we have like some set of questions. We have like 3 questions here. I think, and those questions will be going to you, Christian. All right, the first one says that what are the key components that rating agencies, including Agusto and Co., look at when carrying out a rating process for a company in the real estate sector? That's the first one. And the second question says, what hinders a company from achieving investment grade rating? I guess that is also talking about a company in the real estate sector, right? And the third one is requesting for the slides to the webinar. I think we will send that across after the end of the session. Okay, thank you. So please feel free to send your question. Christian, over to you.
Okay, thank you very much, Ayokunle. I'm not sure I got the name of the person that asked the question, but I will respond immediately. So our rating methodology for corporate rating, which is also industry specific in terms of the weights. I'll just run us through our typical rating criteria for a corporate rating. So we don't just rate a real estate company on a standalone basis. And like I said, when I was taking the presentation, our methodology is a macro to micro approach. So we'll first look at what is happening at the macro level, because we believe no company operates in isolation, and events that happen at the macro environment could positively or negatively impact their ability to meet obligations. So we start by looking at the macro, and then we look at the industry issues. So there could be industry issues that could also impact the ability of the real estate company in meeting its obligations. So we look at the real estate industry, and we also look at the position of the company within the real estate company before we even drill down to looking at the real estate company. So we'll do a deep dive into the financial condition of the company itself, where we look at profitability. Under profitability, we assess, we look at things like revenue growth. We look at the company's operating profit margin, which I had mentioned, these metrics are industry specific. And because of our strong research backbone, we already have sufficient data in our research database that has enabled us arrive at industry averages for this parameter. So we look at operating profit margin, we look at EBITDA margin, we look at return on asset and return on equity. We also review the cash flow adequacy of the real estate company, where we are assessing ability of the real estate company to generate sufficient operating cash flow to meet its obligation. Please, our emphasis here is on operating cash flow. When we're looking at ability to meet obligation, the emphasis is on operating cash flow because we believe that is the most sustainable cash flow that can be used to meet obligation. So we don't place much emphasis on your financing or your investing activity. The emphasis is on the operating cash flow, which emanate from your operating activity. And we want to measure to be sure that that operating cash flow is sufficient to meet critical payment to critical providers of finance, like your lenders and your shareholders, in form of interest payment and dividend payment, respectively. And also we look at the working capital of the company, and we want to assess the working capital of the company with the view to understanding if the company has a working capital need or a working capital surplus. And also we look at the leverage of the company. We want to know the extent of borrowings in the business and how efficient the company has been able to use debt over time. And those are on the financials. And the other soft issues we also consider. So we look at the things like the governance, the board composition. We look at the experience level of management and staff. We look at the quality of the audit report and a number of issues, staff productivity, and a number of other soft issues we look out for in arriving at the rating for a real estate company. So it's not, it's holistic, part of our methodology in arriving at that rating. So Ayokunle, I'm not sure, I hope I've been able to respond to the question.
Yes, you have. Thank you very much, Christian. Thank you very much, Christian. I'm sure if there are further questions from her, she will also she will respond. She will ask more. Right. I think we have a lot of questions here. And I think the next question will be going to you, IK. Right. So this next question is from Omolara Dada. And she want to find out, she want to confirm if the halal or ethical companies are rated based on their ethical space or rate a competition with other players in the capital market. So I guess you want to know that when we are looking at an halal or ethical company, what we use as peers, is it for other peers and other just any other company in the capital market, or do we also look for a company in the ethical space that is also compliant with the halal principle? Thank you, Kristen. I'm sorry, Ike.
Okay, thank you so much, Kole, and thank you, Omolara, for that question. In terms of rating ethical companies, yes, we rate them not in isolation. Where we have peers within the same space, we make comparative with those peers. But I mean, the key fundamental to note here is that these companies are operating in a universe of companies, and the credit quality should be universal across board. So we also tend to measure them against competing companies, necessarily not in the same space. But if we have peers within that same space, yes, we do. And in terms of the instruments that they eventually issue, credit ratings apply across both the halal and non-halal space. We rate sukuks, we rate murabahas, muradabas. So I mean, all of those ethical instruments, we rate them, and our rating definition at the end of it and rating criteria follows the same pattern. However, we give consideration because we know that such companies do not necessarily, their focus is not interest. We actually do those appraisals in cognizance of that, and our rating reflects those. And we've done a couple of that in the past, and we pride ourselves in being very, very diligent in understanding the peculiarities of the sukuk and also of the Islamic finance instruments. So just to give you context, Omolara, I hope that provides additional insight into it. Thank you.
Thank you very much, Ike. Thank you very much. Ike, the next question also goes to you, right? And I think there are two similar questions. I think you can take them together, right? One is from Fausat, and the second one is from B Adiboye. So the first question is, how much impact will the rating of an obligor how much impact will the rating of an originator, have on the rating of a project sponsored by the originator? Okay, the impact of the rating of the originator on the project that is sponsored by the originator. That's the first one. Now the second one from B says that, how does a state government's SPV work? Can the sponsor state be insulated from the debt obligations of the SPV?
Okay, thank you so much, Ayakole. Very interesting and fantastic questions. Thank you, Omolara and B. So starting with Omolara's question in terms of originator and linkages. So originator, it depends on how linked they are to the transaction. You know, just like I mentioned in my presentation, does the originator need to continue to perform some tax for those receivables, those assets to be live? And I explained the scenario of Primero Transport Company, where they have securitized their bus ticket receivables. Without the buses on the road, there's really no way you can actually have bus ticket receivables that have been pledged to repay the bond. So what it means is that at Agusto and Co, when we are carrying out our assessment, we look at the linkages between the originator and the underlying assets. The more delinked you are, the less emphasis we placed on the originator. But the more linked you are, the more emphasis will be placed on the originator. So it depends on a prototype of a case study. We apply our rating criteria accordingly. And speaking to B's question around the SPV for the state government. SPVs are special purpose vehicle. Now, Christian had mentioned in his conversation that these SPVs can either be created by the state government or facilitated by the issuing house or even the trustees. So the big question is, can the sponsor, which is the state, be insulated? Technically, no, because these projects that are being financed for the states, even though we are using an SPV. And recall that this SPV would have pledged either the state IGR or the FAC for the state as a means of repaying the obligations. So technically, the states cannot be insulated. However, what it only does is that it gives them a route to raise finance from the market that is not necessarily dependent on their balance sheet, but the obligations for repaying, which is not tied to the project, is tied to the state. So either the state's IGR or the state's FAC. So definitely the states are not insulated from an SPV model of raising finance. Thank you, Ayokoli, and thank you, B and Omolara.
Thank you very much, Ike, for that answers to those questions. I'm sure you've actually even addressed some of the concerns that Omolara had. The next set of questions will be going to you, Wonu, right? There are two of them, one from Suleiman and the other one from Omolara. So the first question, Wonu, has to do with our rating process, okay? So Suleiman wants to know, if we visit organizations for initial and follow-up ratings, aside from armchair review using financials, okay? That's the first question from Suleiman. And the second question from Omolara says that, can investment companies' ratings compare or compete with other financial industry like banks or MFI, right? So Omolara wants to know if we can compare the investment companies' rating with those of banks or microfinance banks. Thank you.
All right, thank you very much, Omolara and Suleiman. So I'll answer the first question. So you say, do we visit organizations for initial and follow-up ratings? I mean, yes, that's at the heart of what we do. So I'll talk through our rating process very briefly so that you can see where those meetings come into place. So how does the rating engagement start? The first thing is you solicit a rating from Agusto & Co. So that's done through a contract. It's just a page and a half, nothing too technical. Just saying that, this company has solicited a rating from Agusto & Co. We take care of the commercial terms and, we get that out of the way. Once we've done that, once we've been officially engaged, we then send you a questionnaire. The questionnaire itself has questions, and it also has requests for information. So it would ask you to provide certain things. So your audited accounts, depending on the kind of rating, maybe your risk management documents, profile of your top 10 obligors, things like that, depending on the sort of institution. Once we receive the responses to questionnaire, we look through for completeness and just to familiarize ourselves with your business. The next stage is the most important part of the rating process. We have what we call a pre-rating meeting. So that pre-rating meeting, we discuss with the principals of the organization. So we go through the entire functional units. So we speak with the heads of those units. We speak with the managing director. They typically last 2 to 3 hours. So they're lengthy conversations where we try to understand your business, try to understand the factors that have resulted in the numbers that we're seeing. So yes, very important. We do have those pre-rating meetings. After the pre-rating meetings, then we go back to our offices and then now start to analyze and put a ratings report together. When that rating report is done, is reviewed internally, a draft is sent to you as the client. You get the opportunity to review that draft for factual errors, information that you consider confidential that is in there, or opinions that was expressed and that you disagree with, of course, with your reasons for disagreement. When we receive that feedback, we go through, adopt as far as is practicable. In some rare instances where perhaps there's significant divergence in the information that is in the report and your opinion, we would have a secondary meeting to understand the issues that have come up from the draft report. So we would have that meeting as well. But other than that, typically the process is that once we receive your feedback, we adopt, we send to our rating committee, who then decide on what the rating will be. Once we have their decision, we then send you a final rating report, which is where we communicate the outcome of the rating committee's meeting. So that's when you see the rating. And then once we send you the final rating report, you also have about a week to review that final rating document to just to let us know if everything is all right. And then we will typically end the rating process there, barring periodic monitorings. But also where there's where you disagree with the rating outcome, you also have the room to appeal. And the appeals are, again, subjective, but they're subject to you being the client, being able to provide information that was originally not considered in the determination of the rating. So there are many instances where we interact with the client. And beyond these formal meetings as well, we have telephone calls to the different principals, just trying to understand information that has been provided to us. So we interact with you all through the process via emails, via telephone calls, text messages even. So yes, so the lines of communication are quite open. So I think that answers Suleiman's question. Then the second question I think is by Omalara, where she says, can investment companies, can the IM ratings, I'm assuming she means, be compared to the ratings from banks and MFBs? So like I said in the presentation, the IM rating is unique. It is not a credit rating. It is not a financial condition rating. It does not measure the financial strength of an organization. The ratings that we typically issue to banks and microfinance banks are credit ratings. They are financial condition ratings, and they measure the financial strength of those institutions. So it would not be right to compare an investment manager rating for an asset management company with the credit rating of a bank or a microfinance bank. However, where the asset management company has decided that, okay, I want a credit rating, where you're saying, I want to measure my financial strength, I want to measure my credit worthiness, we can then conduct a credit rating for the asset management company. And that credit rating is then comparable with the credit rating of any bank or any microfinance bank. So I hope that I was able to answer that question, Omalara. Thank you.
Thank you very much, Wonu. Sincere apologies, Lola. Yeah, your name is Omolola Dara. Apologies, sincere apologies. I ordered your name initially. Apologize for that. And let me also add to what Wonu just said. Suleiman, after the rating process, we also conduct credit monitoring all through the life of that particular rating, right? And that one also at times can involve meeting with the management team of the company to find out more about the company. So it's not only armchair review like you said, right, that we also conduct. And I think there was a question for IK. Okay, I think I can say the question again. Right, so the question is about IK. The question was about if the documents doesn't meet the standard, what do we do? Right, IK, I'm sure you saw the question. Can you please just help us with the answer to that particular question?
Okay, thank you so much, Kunle. I think the question was around if they are unable to meet the rating standard, and how often is the document actually reviewed. So which I've tried to provide response that our ratings are assigned based on our rating scale from AAA to D. However, when we do not have sufficient information to conduct our appraisal, then we'll not be able to assign a rating. So Agusto & Co.'s rating is dependent on the quality of information that has been provided. Where we think you've not provided us sufficient information, we will not be able to provide an opinion. Remember, it's an opinion on your credit strength, and therefore we need to have been provided sufficient information and affirm that this information is sufficient for our rating committee, who is actually the one who actually assigns a rating. So maybe just to put that into context, that no analyst at Agusto & Co. is responsible for issuing a rating. What the analyst typically does is to provide the analysis, and it gets sent to a rating committee. A rating committee consists of 4 to 5 members who sit independently and are very versed in credit, and they're able to provide opinions on the credit of that particular. And it's on the back of that opinions provided by the rating committee that the analyst now convinces or sends you a letter and an email notifying you of the rating that has been assigned. So if the committee is unable to form an opinion because sufficient information has not been provided, then there'll be no valid rating assigned to that particular entity or instrument. And our ratings have a validity period and are typically renewed on an annual basis. So I think that answers Omolola's question in terms of if it fails to meet the rating standard, we will not be able to issue a rating, and it's actually renewed annually. Thank you.
Thank you very much, Ike. Just to remind us again, please send in your questions, if either based on what we've done, what we've discussed today, or any question that relates to rating, right? You can send it through the Q&A section, through the normal chat box, right? You can also even send the question to us. While we are waiting for other question, Kristen, I think something that you might want to just talk a bit around is this. You mentioned 3 different structures that we can have for state governments, right? You said we can have those issued on the balance sheet on the state government, you can have the sukuk, and we can also have the quasi-corporate, okay? Now, talking specifically about the sukuk and that's the bond, right? Are there some differences, right, in how we actually assess these instruments? If there are, please can you just briefly just clarify that to us? Thank you.
Okay, thank you very much, Ayokunle. So basically, our methodology is the same, but because the 2 instruments differ in their nature. So for the conventional bond, we're looking at ability to meet coupon and principal repayment. And for the sukuk is also ability to meet the lease payment, the lease rental for the sukuk. So it's all depends on the structure. So no single bonds can come in different structure, the conventional bond. So some can have the XPV model where the state is issuing through an SPV. It can be on the balance sheet of the state. So when it's on the balance sheet of the state, it's a direct review of the state's ability to meet the obligation. But if it's then through an SPV, we then have to also look at it as though the state is the primary obligor, and then we look at the credit enhancement as I had discussed earlier. And the same thing applies to the sukuk as well. So the thin line just lies in the nature of the 2 debt instruments. So one is talks about interest payment, and one de-emphasizes interest payment and talks more about lease rental.
Thank you very much, Kristen. Thank you very much, IK, and also thank you very much, Wonu, right, for being the panelist. I think at this time we will invite, we don't have any more questions, right? And I think at this time we will invite Mr. Isaac Bami. Mr. Isaac. Okay, I think a question just came in. Okay, please, I want to clarify again, if a company can have credit rating, investment rating, and risk rating at the same time, or is it just one rating at a time? Okay, and can the company graduate in having one after the other, right? Or I'm sure Olala wants to just find out is, can we have all of those at the same time?
Okay, thank you very much for that question, Omolola. So yes, a company can have different ratings at the same time. And we do have asset managers that carry more than one rating. So the objective is the question. So what do you need a rating for? As an asset management company, that's a question you would need to be able to answer. So first off, if you're trying to access the debt capital market, that means you want to raise money, you want to raise a CP, raise a bond, then you need a credit rating. That's the rating that can enable you to do that. But if the rating that you require is so that you can get investors, so you can show to your potential investors your skill level, you can get PFA money, or you can get international investors to work with you, then what you require in that sense is an investment manager rating. And yes, you can have both simultaneously because you can have both objectives. So you might intend to raise money from the debt capital market, and you might also need, to market your strengths and as an investment manager. So we do have entities that have both, where they have credit ratings and they do have IM ratings. But I think the pertinent thing is to understand what each rating says. So what can this rating do for you? So the IM rating, what it can do for you, it can strengthen your funds under management. It can help you access markets that perhaps you hadn't accessed before, get foreigners to invest with you, get PFAs to invest with you, things like that. But with a credit rating, what that would do is it's signaling and saying what your financial strength is, your repayment capacity, and therefore you can use that to access credit in the debt capital market. So I think the answer lies in the reason that you were requiring a rating in the first place. So I hope that answers your question, Omolola.
Thank you very much, Wonu. Although we don't have any more questions, although we want to wrap up now, but the conversation continues. Please note that you can reach out to us if you have any question, if you need any clarification as regards rating or any of our products, right? And also concerning the slides, we'll send the slides to you after the session. At this point, let me just invite our Executive Director, Mr. Isaac Babatunde, for the closing remarks. Thank you, sir.
Thank you, Ayokuli and everyone. Before the closing remarks, let me just make a few comments on the issue of Sukuk. You know, in addition to all the criteria that Kristen mentioned, it's also important that Sukuk should be compliant with the Sharia requirement. The Islamic finance requirement must also be complied with, in addition to all the other quantitative factors that we'll be looking at. So on this note, on behalf of the management and staff of Agusto & Co., I would like to say a big thank you to all the participants for taking the time to attend this webinar on our less popular ratings for structured finance, state government-backed special purpose vehicles and asset managers. We truly appreciate your support and we look forward to staying in touch with you. Please do not hesitate to reach out to us if you have any further questions or feedback regarding the presentations that have been made today or any aspect of our ratings generally. Like you have, Ayokule has mentioned, we can be reached by email. You can send email to us through info@agusto.com and then we'll respond to your clarifications or questions. Thank you so much. Have a good and productive day. Thank you.